Hi traders, welcome back to the channel. So I hope you're enjoying your summer. Hope you're having actually a good trading summer too. I know it's a little volatile, these markets, and very challenging to be honest with you, including myself. I took a little downtime yesterday to a nice little day trip to Philadelphia, Pennsylvania, explore some of the history, some of the culture there too. Again, no trading, just to sort of clear my mind. So you may see some nice little B-roll footage of my journey too. It's hot as hell, 103 Fahrenheit, which is about 35, 36 Celsius. Crazy, but at least it got me away from the markets, and I kind of didn't miss it at all. So I want to do a hopefully quick video today, just to reinforcing or just really drilling down into the specifics of this risk management and stop thing. I see too many traders, even seasoned and development traders, kind of playing games with where we want to adjust our risk and where we want to place them. And really, I'm more of an optimization guy when it comes to risk management and looking at math and let them determine that. But I know emotions can be a part of it. So let's cut to the chase, do a quick video tonight on a few pointers that you can take starting tomorrow on how to finally attack this risk stop loss issue. All right, so this topic, of course, is near and dear to me, and it puts a little energy and kick into my step when I talk about risk management, particularly in exposure, not necessarily portfolio exposure, and we can talk about that in a different video, but really about stop loss management. All right, I want to give you a few tips to think about. All right, I understand that the cool thing about traders is we have so much flexibility in what we need to do, and we can adjust things based on our personality, our risk tolerance. I'm all for that. But at some point, the math has to come into play. And when we deviate from the optimizations, that's when this risk management thing becomes a problem. And I see it. New traders, I expect it. But seasonal traders, like 2, 3, 5 years, when they start asking me, where should I put my stop? I kind of have to question and say, you have to have sort of some defined rules in place to do it. And how do we develop those rules? Optimization. All right, we'll take a look at a few of these tips, and I want you to get your pens or notepads ready. Have a quick video on this. By the way, if you want to hear more about this, I did some work on the risk management process and sort of principles of risk management that go beyond stop losses. All right, I'll just click on the link below, and I'll be happy to share that with you. I'm really proud of a lot of the work I've done in risk management, and sometimes I feel like I kind of suck as a trader, but this risk management thing I kind of got the hang of. All right, let's go to the first one. All right, so I kind of hinted it before in the intro. Right? Comfort is not a factor in stop loss placement. Right? Optimization is. It's really about the math. Where is the optimal place to place your stops? Right? I understand risk tolerance has a lot to do with it, and you can adjust based on sort of your conservative nature, things like that. I'll have other factors too. Like if I have 4 positions and they're all in, say, Mag 7 NASDAQ and I'm all long. That fifth one, even though it's a valid trade, I might adjust my stop or reduce size to factor that in to the play. So I'm going to have a little portfolio risk management factor into it. But when it comes to specific stop loss management, let's try and strip away the comfort, where I want to place my stop as far as comfort, and where is the optimization point. Remember, we're here to do a job, and I know it's not easy, right? And sometimes it's very uncomfortable, right? But I have to go with the math that says this is where the optimal stop is. My personal preference, and at least a lot of the math has shown, that not just a dollar amount. The market doesn't care about your dollars, all right? And the market doesn't care about, 5-minute bar wicks. But certain areas that if it has to breach, it's like, okay, market, I'm going to hide behind this wall and come around and get me. Those, at least historically from the math and my research in 20 years, overall has this sort of optimization point where not only does price have to sort of reverse and go against you, say, okay, so obviously something's wrong here, but the uncle point. And the uncle point is it obviously broke through some type of either support resistance, supply demand, sort of this wall. They say, okay, clearly this isn't working out, right? And I know sometimes placing those stops in that area is maybe a little longer than maybe say below a 5-minute bar, but the 5-minute bar really isn't telling you much. It's just could be just randomness and noise. How do we know that? We don't. We have to do our analytics and really get a historical sense of what the math is telling us. All right. And any of you have traded a strategy, or if you've come on board a group that has a strategy, they should have these sort of analytics for you. All right. Where is the stop placement? May not be the place that you want to have it, but it's where the optimization point. So start to think about and start to build that muscle of getting away from comfort. Where's my risk loss going to be on from a comfort level versus where the optimization point should be? All right, next, and this is kind of a doozy. Don't discount the requirement for patience, discipline, and I'll even throw in variance into the mix of where the stop placement should go. Now that's a handful. Let's dissect it. All right, patience. Well, if you have a stop at X, right, and things aren't working out, well, price may take a while to get to that stop point. All right. You have to have the patience and discipline. And I'll go back to number one, trust the process, trust the math, and say, okay, not everything goes in a straight line. All right. There's red on my screen sometimes before it goes green. That's the whole idea of a proper strategy and a historical strategy, which has math behind it and has a positive expectancy. It requires, or it's embedded in that profit factor, patience and discipline. All right. Just because it goes south or just see the first red bar, you cut it. Now we're getting into comfort, or now we're getting into fear. All right. The ideal stop placement sometimes requires discipline, patience, and variance. And the question is, do you have that? Okay, it's okay. Build that muscle. Place it in your journal. What was your discipline rating there? What was your patience rating? Did you just quit because you just got frustrated? All right. And what is the normal variance? And this should be part of your back testing. It's not about what's my positive expectancy or what's my result in the back test. Yeah, it helps. But I want to know, I'm really focused on what's the variance. All right. If the variance is, like, say, this wide, do I have the stomach or the capital to absorb that hit? Or do I have to reduce size if I'm able to accept it? So you can really add a rule into your strategy and not deviate from stop losses and say, all right, this is where they tell me the stop loss should be. That's the optimization point over a series of back tests, or using it live for, say, 10, 20 years, whatever the case may be. All right, I got to adhere to that rule. Well, if I can't move my stop, because that's the strategy, all right? That's what's it's supposed to be. What can I do? Reduce exposure, and that's what you do is reduce size. So rather than keep your stops really tight, right, which is basically like death by 1,000 cuts often, and death by career, death by 1,000 cuts. What we're going to do is reduce size to be able to allow you to play the game. That's the way you sort of get around the risk management. Where do I put my stop issue? All right, and the last point I want to bring up is we have a natural inclination to use our stop losses as a price point, or a target as a price point, or if you trail, multiple targets, T1, T2, okay, this price point and that price point. But start to think about other factors would trigger your stop loss. All right, now there's a double-edged sword here because I don't want people to get too aggressive with it. But think about when a market has changed its context. And I don't mean, oh, here's a red bar on a 1 minute that everything's changed. But has something dynamic changed that will allow you to say, you know what, I have to cut this because this is part of my rules. All right. And it's not necessarily technical indicators. It could be using market profile, or, the advanced declines have now gone negative, something like that. All right. Internals, I call them under the hood. All right. Those are the key drivers of my stop loss management. Very rarely does my trade actually hit my stop loss. It's really more catastrophic in nature, in the sense where, wow, this really didn't go wrong, and it went wrong pretty badly and relatively fast, even though I had the patience and discipline to pretty much watch the train wreck. All right. But a lot of times it's market internals, and that's a different story for a different video. But the market internals and the market context, like I said, I call them my indicators under the hood. The advanced decline, right? When I'm trading equities, the New York Stock Exchange tick, what are the readings that are going on over there? So there's another avenue to factor in your stop loss management, right? That may be the trigger, not necessarily price. Remember, price is simply just an advertising mechanism. It's really there like to lure you into the trade or scare you out of it. Let's look at the internals to make those stop loss risk management decisions. All right, so I hope you got some cool tips today that you can apply, first thing tomorrow morning. And understand that I get it, all right? We don't want to risk so much, right? I don't want to risk more than X amount of dollars, but the market doesn't care about your money. In fact, it seems like there's a beeline to try and get that money, all right? Don't you have those days where you feel it? I do all the time. All right. Even after 20 years of doing this, I feel like they're trying to get me. They're trying to get me. All right. Understand that patience and discipline to let the play and let the trade work out, let the math do its thing is so, so important. I said time and time again, and I kind of sound like I'm preaching sometimes, but is this is really just a game of math. This could be two squirrels running down the street and you're betting on which one is going to be first. The math says that 70% of the time this one does it with reasonable risk management. I'm taking squirrel number 2. Keep it into the math perspective, build that muscle for holding, and understand that it could be uncomfortable to place your stop in certain areas. Again, reduced size will reduce that comfort. And understand if you want to adjust, lean more towards reducing size as opposed to disrupting the mechanics of a math equation that's already been set to have a positive expectancy. All right. Again, click on the link below. I'll give you a taste of really the risk management philosophy and principles that I want you to apply, not just for stop loss management, but for your entire trading plan and your journey going forward. It works in trading, it works in all math equations, it even works in the corporate sector for strategic planning and things like that. Those principles never really go away, and it's really been the bread and butter that's really led me to have a pretty interesting career so far. Hopefully, I don't blow it this year. All right. Hope you enjoyed this quick one, and we'll see you next time.